Let me start by saying this. I like QQQ. I own QQQ. But if you told me that I could only buy one technology ETF going into 2026 and it couldn't be QQQ, my answer would be this. Everywhere I look, QQQ dominates the conversation. It's the go-to for growth, the default choice, the ETF that everyone seems to own and a lot of people has at least heard of. And yeah, it's done really well. I have a huge position in QQQ, but there's another ETF that is a better bet on tech, something that has more exposure that actually makes sense for the next decade, a true tech ETF. Look, I've studied hundreds of ETFs, tracked the performances across multiple cycles, and looked under the hood of many portfolios. And after all of that, I can confidently say that there is one tech ETF that I'd buy in 2026. Not a flashy new one, just one precise way to own technology. And in this video, I break down why QQQ isn't my primary tech ETF, what makes my ETF choice fundamentally different, how it has performed over the past decade, and then why I believe that this ETF is better positioned for the next decade of technology-driven growth. If you're new here, I'm Dalal. I've been investing for over a decade. I did not start with money or any shortcuts. I've made every mistake that you can imagine, learned the hard way, and figured out what actually works. I'm an entrepreneur and investor, and I'm here to share the lessons that I wish somebody would have told me from day one. Quick disclaimer, none of this is financial advice. I'm just a guy on YouTube with a mic. So always do your own research before investing. And this video took a ton of work to put together. If you find any value whatsoever, please hit that like button. It helps me more than you know. When most people think of a tech ETF, they immediately think of QQQ. QQQ tracks the Nasdaq 100, which includes many of the biggest and most influential technology companies in the world. It's delivered great returns over the years, and it has become one of the most widely held ETFs on the planet. QQQ is Invesco QQQ Trust, and it has done exactly what it has set out to do, that is give investors exposure to large growth-oriented companies listed on the Nasdaq. If you've spent any time investing in growth ETFs or even looking them up, then you have already heard of this fund. It's classified as non-financial, so no banks and no insurance companies. And what that does is it naturally tilts that portfolio towards tech, consumer tech, and communications. So investors consider this their tech investment. You're getting Apple, Microsoft, Nvidia, Amazon, Google, Meta, Costco, basically the backbone of the economy, all inside this one ETF. So definitely tech heavy, but not pure tech like the ETF that I'll mention in just a minute. Let's take a look at the numbers so we can compare them fairly. The expense ratio is 0.2%, so that's $20 per every $10,000 you have invested. The 1-year return was 24.18%, and that 10-year annualized return is 20.38% per year. Just to show you what I mean by this, over the same stretch, the S&P 500 averaged roughly 14 to 15%. So QQQ has beat the S&P by 5 to 6 percentage points. But here's the first issue that I have with QQQ. It's not actually a tech ETF. Yes, it's tech heavy, but structurally, QQQ is a mix. It includes tech companies, consumer discretionary companies, communication companies, and even businesses that aren't even tech at all. That means when you buy QQQ, you're not making a clean bet on technology as a sector. You're buying a mixed basket of growth companies that happen to be tech-led right now. Now, this has worked incredibly well over the last decade. But going forward, if we want a pure tech ETF that has a history of performing well and we care more about precision than popularity, then we need to look at other ETFs that can be a good fit for our portfolio. I want to know exactly what I own. I want to know why I own it. That's where VGT comes in, Vanguard Information Technology ETF. VGT structurally is very different from QQQ, but with a lot of overlap, and those differences explain why VGT has actually outperformed QQQ over the last decade. VGT tracks information technology only index using GICS classifications, and that means companies like Amazon are considered consumer discretionary and Google and Meta are communication services, so they're not included here. Instead, VGT goes wider inside tech itself. It holds over 425 companies from mega caps like Apple, Microsoft, Nvidia, all the way down to these mid and smaller cap firms that you will never see in QQQ. I'm talking hardware, software, semiconductors, IT services, the entire entire tech ecosystem. And I like that because if one of these smaller cap companies does really well, it will reflect really good on the returns that we can make. So let's compare the returns versus QQQ. For VGT, the expense ratio is 0.09%. That 1-year return is 21.78%. And the 10-year annualized return is actually 22.71% per year. That 10-year return is actually higher than QQQ's. Without Amazon and without Google, pure technology has been that dominant. And the fee of $9 for every $10,000 you have invested, that's basically nothing. The only caveat again is that VGT and QQQ do overlap heavily at the top. If you already own QQQ, then adding VGT doesn't diversify you as much as you might think. But as a standalone position or as a core tech heavy growth portfolio, VGT is one of the best ever created, and that's just my opinion. VGT owns technology companies, full stop. No consumer brands, no retail. So if a company is classified as information technology, it belongs in VGT. If it's not, it doesn't. Let's actually look at the holdings. The top 10 positions make up roughly 58% of the total assets, and they include many of the same elite companies you'd expect to see in QQQ. So names like Nvidia, Apple, and Microsoft, alongside these other major technology players like Planeteer, Micron, and Broadcom. This level of tech concentration is actually very important to me as an investor. Technology isn't becoming less relevant over time. It's becoming more critical, especially as AI and automation continue to reshape the global economy. One of the most common criticisms I hear about VGT is its concentration, particularly its heavy weighting towards companies like Apple, Microsoft, and Nvidia. But concentration isn't always bad, especially when it's concentrated in dominant technology businesses. Beyond these mega caps, VGT actually holds mid and small cap tech companies, many of which have massive balance sheets, generate enormous cash flow, and they reinvest aggressively into growth and essentially build these ecosystems that are extremely difficult to disrupt. Unlike QQQ, VGT stays purely focused on technology, given exposure across operating systems, cloud infrastructure, semiconductors, enterprise software, cybersecurity, and payment processing technology. That kind of focused end-to-end tech exposure is exactly what you want long-term. These aren't trends that come and go. They are foundational layers of the modern economy. Every business, whether it's healthcare, finance, manufacturing, or logistics, relies on technology to function. VGT owns the companies that make that possible. Okay, now, full transparency, I own both QQQ for growth and VGT for tech. The real test of any investment isn't how it performs in a good year. It's whether you can stay invested during the difficult ones. I'm comfortable holding VGT through the market pullbacks, recessions, interest rate cycles, and even periods where technology temporarily underperforms. That confidence comes from a simple belief that technology isn't optional anymore. It's not a luxury, and it's not a passing trend. Technology is the operating system of the modern world, embedded into how businesses run, how consumers live, and how economies grow. As long as that remains true, I'm willing to stay invested for the long haul. At the end of the day, this isn't about chasing what everyone else is. It's about alignment. It's about owning what you believe will matter 10 years from now. And it's about having the conviction to hold it. QQQ is a phenomenal growth ETF, and it deserves the reputation that it has. That's why I hold a position in it. But if I am making a long-term bet specifically on technology, the systems, the software, the infrastructure that power the modern world, I want only tech. I want pure exposure to the companies actually building the future. That's why VGT isn't just an alternative for me, it's my long-term tech conviction. Technology isn't slowing down, it's accelerating. AI, cloud computing, semiconductors, cybersecurity, and enterprise software are not optional, they are foundational. And VGT owns the backbone of the entire ecosystem. You don't need a dozen of tech ETFs, you don't need to constantly rotate or guess what's next. Sometimes the best strategy is choosing one great vehicle, understanding it deeply, and letting time do that heavy work. If you think long term, if you believe technology will continue to shape the world, and if you want to invest with intention, then now you understand why VGT is the only tech ETF I'd buy heading into 2026. If you're still watching, drop a fire emoji in the comments below. If this video has helped you in any way, please hit that like button. It really helps the channel. And if you want more long-term, no BS investing content, make sure to subscribe and watch this video next. I'll see you in the next one.